Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome Matt Cole. He is the CEO of Strive Funds, an asset manager that has been building an impressive track record. Matt, welcome to the show.
Thanks for having me, Nick.
So you guys just raised $750 million for a Bitcoin strategy. I want to understand that, but first give us a little bit of background about Strive and how you guys got there and your personal journey as well.
Yeah, absolutely. So Strive was founded in 2022 by Vivek Ramaswamy. I was part of the day one team, and we're an asset manager. So over the course of about 2 years, we've raised over $2 billion of AUM. We have 13 ETFs, 11 are passively managed equity funds, 2 are actively managed fixed income funds. And just to give a sense, the $2 billion of growth is record breaking in the ETF space. We're one of the fastest growing ETF issuers in 20 years. We are growing basically at the pace of JP Morgan when they got in the ETF industry, ARK, Cathie Wood's funds, and Pacer combined. And so it was unprecedented growth. And our mission was focused on taking advantage of an inefficiency in capital markets where no one was focused on proxy voting or corporate governance. They were always focused on just fees and the beta side of things. And so we focused on pushing corporations to drop things like ESG mandates in focus of unapologetic capitalism. And the markets really liked that. We had so much success that the ESG movement has collapsed just about 2 years after the launch of our funds. And so when we were looking for the best way to maximize value for our shareholders, adopting a Bitcoin treasury standard became an obvious next place for us to go. So for those that don't know, I am a longtime Bitcoiner myself. I put pretty much my entire net worth in Bitcoin in late 2016, early 2017. I haven't looked back ever since. And so why did I do that? I did that because my background prior to Strive, I was working at CalPERS. I was one of the largest buyers of U.S. treasuries in the United States. So CalPERS is the largest pension fund in the U.S. They're about a $500 billion asset manager. I managed about $70 billion of their assets, their U.S. treasury portfolio, their structured products portfolio, which is actually relevant for a Bitcoin treasury company as you think about what's happening in the space and all these different instruments that Strategy's offering that are all different times of structuring. That's my background. And so it became obvious for us to take that next step. And so we did so. And when we did so, and we'll get into this, I'm sure, we could have done a SPAC. We chose not to do a SPAC. We could have announced a SPAC several months ago, but it was really in about early 2025, so call it like January-ish, that we decided we are going to become a Bitcoin treasury company. And instead of doing a SPAC and announcing it in January of this year, we knew that a reverse merger was the best route to go. We can kind of get into some of the reasons why, but reverse mergers allow for you to be shelf eligible. So to actually do things like when Strategy announces STRF, STRK, STRD, STRC. Why are they able to do that? Because they're a well-known seasoned issuer. They're a company that has a track record as a publicly traded company. They're shelf eligible. And so for a SPAC, you don't have those things for the first 12 months post-close. And so a SPAC, you have to wait typically a little bit longer to close than it's 12 months post-close. So we did what I think is the hard thing. We found a company to say, we will reverse merge with you. So we announced that in May of this year. And now we're tracking for, call it a late summer, early fall close of the transaction. And then we raised a large pipe. And that large pipe is also relevant for 2 reasons. One, it obviously allows us to buy a lot of Bitcoin and catapult us into one of the larger Bitcoin holders in publicly traded corporations. But it also shows the institutional acceptance and excitement for what we were doing. And so we didn't just say we're going to do the exact same thing as Strategy. We also laid out a handful of alpha strategies. So almost like hedge fund type strategies within our operating company, because we're an asset manager, and alpha is what our team does.
That's fascinating. And I want to ask you a follow-up about coming from CalPERS. Now, for the viewer, Matt and I come from the same world, fixed income buy side. We are fiduciaries in that we have portfolios, and those portfolios, we have to invest them on behalf of the client and do right by the client, by their mandate, invest safely. And so Matt and I have a very similar background in that regard. So I want to ask you, on the fixed income buy side, what did you see about Bitcoin? Or perhaps I'm projecting my own experience onto you, but what did you see about the size of capital that you were dealing with versus the tiny size of Bitcoin at the time? Why did you decide to make that jump 2016, 2017? What was it about Bitcoin? What was it about your seat at CalPERS? Give us a little bit of color there.
Yeah, absolutely. So when I was buying U.S. Treasuries, and so obviously also buying agency mortgages, they're all related, right? But it was during the era of QE. And so during that era of QE, you would see the Fed announcing large buys of treasuries, of agency mortgages. And then when you're on the buy side and you're a large account, you get direct access to talk to people at the Fed, talk to people at the Treasury. And so we were frankly just concerned about the deficit, about the spending, and about the monetization of debt by the federal government. And so we would talk to them, and they would give very vague answers. It's not printing money, and you'd get into it, and what you would learn is that by a technical definition, it's not printing money, but it is the monetization of the U.S. debt when the Treasury issues debt, and then it goes to a bank, and then the Fed buys the debt from the bank. It's one step removed from a direct monetization, but that's what it was. And so that was the view on the fixed income side. Obviously, it's not tied to CalPERS at all, and we would always ask, well, what's the plans for the U.S. government to actually start getting the fiscal deficit situation under control? And all you would hear was this continual kick the can down the road. And that was true in the US, it was true in Europe, it was true basically in all areas where there was fiat currencies. And so we just saw the debt situation getting worse and worse. And this was before I was a Bitcoiner. It just felt like there was no answer other than we're going to kick the can down the road until there's an eventual default by one way or the other. And my view is that monetizing the debt is the slow motion version of a default. It's not a technical default, but you're devaluing the dollar. And so that was the backdrop. I knew about, and this was, call it, 2010, 2011, 2012, 2013. I knew about Bitcoin around that time. I just thought it was silly internet money. And the reason that I thought it was silly internet money, and it took me a while, was I was a large institutional investor, and I learned about Bitcoin on a bodybuilding forum. And so you see these bodybuilders talk about magic internet money, and it's going to fix the world. And it just felt like, how could that be the answer when, I'm talking directly to the Fed, to the Treasury, to the largest banks and institutions in the world, and none of them are talking about this. So it took me several years to say, finally, I don't see an answer over here. In my view, Bitcoin became the only answer. And I think it still to this day is the only answer, and opt out from fiat currencies. And I mean, frankly, fiat currencies typically they don't last for thousands of years anyway. So this is actually the fall of fiat currencies is actually part of nature, in my view. It's Bitcoin that's the innovation that becomes the answer, and the new thing, but there always will be a new and a better thing, and Bitcoin is that better thing. It's perfect money, and it's the first time we've actually seen deflationary money and hard money. And I think that the markets are still working to understand that, and it's really a beautiful thing to watch.
Agree. And probably one of the things that you and I both did is followed the individual QSIPs from the Treasury Department into the Soma portfolio, thus proving to ourselves the debt is being monetized despite the semantics. And I'll just explain that to the viewer. When the Treasury issues a bond, each bond has an identifier. Those bonds get auctioned, and the primary dealers pick up a chunk of them. And so you watch the bond go from the Treasury Department to a Goldman Sachs, for example. Then you see the Fed in its open market operations buy that same new bond, 2 weeks old, 3 weeks old, from Goldman Sachs, and it ends up in the Fed's portfolio. And so, yes, there's one step removed and they can escape the semantics of debt monetization, but we're not idiots. And so that's, you know, something that I think people broadly understood at the time, that you can't just gaslight us, that this isn't debt monetization. It is. And we're not some, I wouldn't say we're some beyond sophisticated technical people. This was not a difficult thing to see a bond ticker go from the Treasury to Goldman to the Fed all within a span of a few weeks. So I think it's important, Matt, to sometimes slow it down and explain that aha moment to people, because let's say you and I might have a different opinion on how long the fiat system can last, right? I tend to think it can last many, many decades, and that might be more than some other people. It doesn't mean that they're not in slow motion default as you described. So we can agree exactly on that while disagree on the timing. And I think all of those perspectives are different depending on what your career background is. But at a certain point, we have to call a spade a spade.
Yep. No, I totally agree, and I would love to hear your view on the decline of fiat currencies and it taking decades. And that is actually my view as well. My view is maybe slightly nuanced, maybe the wrong word. I'm sure yours is very nuanced, but I do have a nuanced view of how that plays out. And the view is that I do think we are in a secular decline of the dollar relative to other fiat currencies. So that's not obviously a Bitcoin argument. And I believe that that's been in place in slow motion for the last 40, 50 years. And so we're, and I think we kind of went up against a top trend line, but I do think that the dollar has more to lose relative to other fiat currencies because it's the global reserve currency. And so what I think happens over the next decade or so is that DXY specifically, which is the dollar relative to a basket of fiat currencies, for those that don't know, that it kind of goes in decline to low levels, but levels that have been seen, or maybe slightly below levels that have been seen historically over the last 40, 50 years. So that is not calling for the collapse of the dollar. It's calling for the weakening of the dollar. And a weakening of the dollar will be likely beneficial for Bitcoin relative to the dollar and just Bitcoin at large, because it would be the weakening of the global reserve currency. And then it gets a little bit convoluted for people, and myself included, that all fiat currencies are being devalued, or almost all the large major ones. And so relative to one another, they might look fairly stable, but that's because the Fed talks to the ECB, and they're all working not explicitly in connection with each other, but implicitly they work together to stabilize market liquidity across the globe, because we do have a global financial system. But I think that the dollar declines. I don't think the debt situation improves, and so I do think that fiat currencies weaken. Bitcoin goes up a lot, but I do think that fiat currencies can survive for decades to come. But I don't think that necessarily means that Bitcoin, even in that scenario, can't go into the millions and millions of dollars as because if you think about what's happened even since 2017 to now, which has obviously seen Bitcoin rise from $1,000 to $100,000 plus, the DXY has actually been in a pretty narrow range. It's had movements, but if you actually look at the chart and you zoom out, it's been in a fairly narrow range. So if we actually see a true decline that we have seen several times over the last 40, 50 years, if we saw that play out, that would be, in my view, extremely bullish for Bitcoin. And it's part of the reason why I think that we may not enter into an era over the next 5, 10 years where Bitcoin's returns actually slow down versus what they have been for the last 7, 8 years.
It's fascinating. I'm looking at the chart here on DXY at around 97, breaking through this support, multi-year support. And I mean, 85 looks very reasonable on the chart. We have some great sponsors at the Bitcoin layer, sponsors that are helping us deliver the highest quality research to you. But not just any sponsors. We want to bring on partners that are adding value to your Bitcoin process and journey. If you're serious about your Bitcoin, you need to start acting like it. Unchained just launched the Financial Freedom Bundle, a curated pack that includes a premium Bitcoin book, a new hardware wallet guide, and access to a private event with Tour de Meester. It's time to take control of your generational wealth. Make sure you go to unchained.com/TBL to request your financial freedom bundle. That's unchained.com/TBL. Human Rights Foundation presents the Financial Freedom Report. Go to financialfreedomreport.org, sign up for the free newsletter today, and get involved in the freedom aspect of Bitcoin. Bitcoin is a human right and it is evolving as such. Make sure to go to financialfreedomreport.org, sign up for their free newsletter, and learn all about how Bitcoin is at the cutting edge of providing people with human rights. Smart macro analysts don't just watch the Fed, they watch the world. I think that your nuanced view on the decline of DXY, especially given recent price action and maybe a shift in geopolitics contributing to it, very, very interesting to think about how Bitcoin could perform in a weakening dollar environment. And from our framework, where we have our own index TBL liquidity, part of it is DXY in an inverse. So when DXY goes down, it's supportive to global liquidity and the idea that credit creation becomes easier as the dollar goes weaker. So something very, very important to think about. And I would tend to agree with you that, at least from the chart perspective, DXY has lost some significant support in the past 3 to 4 monthly candles. And that spells potentially a multi-year bear market for DXY here. And Bitcoin on the other side of that benefits in two ways. One, on the numerator denominator side, but also, like you say, going a little bit away from the dollar or the dollar losing its reserve status at the margin where Bitcoin picks it up, and not necessarily even other fiat. I think that's part of the nuance. Do you want to talk about that little specific part of the DXY, which is potentially the strengthening of other fiat versus the dollar, but then relate it back into Bitcoin?
Yeah, absolutely. So why? So the dollar versus other fiat currencies is multifactorial in many different areas. But one of the things that happens when the dollar is strong is that it's showing support for the dollar as the global reserve currency. And so within the dollar has been the global reserve currency for decades. And so when we look at this, when I talk about this 40, 50-year chart of DXY and kind of a 40, 50-year decline of the strength of the dollar's been the reserve currency through multi-year, decade-long bear markets and bull markets. It's just really the strength of the dollar as a reserve currency. And I think when you think about where we're going, and even ignoring Bitcoin for a second, you think about AI, which I think AI is going to be a massive redistribution of power and of education around the globe. And I think that is something that will take away power from America and the university systems, as people can get great educations no matter where you are. I was just talking about with my wife about this. We're right now, in northern Idaho and in some very rural areas, and we passed an elementary school, and I'm like, man, these kids now probably have access to more information than they've ever had through AI, but that's true globally. And I think that's going to be a weakening force. You look at the fight right now between the Treasury and the president and the Fed. I mean, I have not been of the view that the Fed is independent for a long time, but from an institutional perspective, that is still widely accepted that the Fed is an independent body. And I think that is being questioned right now from everyone. Well, if the confidence in the Fed's independence goes down, that should weaken the dollar as a global reserve currency, by definition. And then you look at the fiscal deficit problem. I mean, it was literally a couple months ago that we were all talking about Doge and the ability to slash spending. Doge has collapsed effectively. There is now no one on either party that's even putting up a fight that we're going to be fixing the fiscal problem. And so the dollar is being attacked from every single angle that is out there. And I actually even think that things like the Genius Bill, and this may be somewhat of a controversial take, but I don't think that that's going to actually substantially increase the demand for stablecoins globally. I actually think the best scenario for stablecoins globally is basically an offshore dollar like Tether that's less regulated from within the US that's able to sell dollars globally, I think that's probably most likely what people like Chinese billionaires would want. I don't know that they are going to want the tether version that's pulled into the United States and more directly regulated. I think that's closer to what a CBDC would look like. And I think that's going to be a little bit more dangerous for people that kind of are looking from an opt out from their dictatorship countries. And so, I think from every different angle that the dollar is being attacked right now.
This is an excellent take, and I don't say it often on the show, but some of the listeners are going to want to run this back twice because what you're describing with Tether is so important. This offshore onshore dollar difference and the utilization of the offshore dollar is because of emergent demand for the offshore dollar. It's because of a demand for dollars that do not want onshore dollar exposure, whether it is JP Morgan's dollar coin or the Feds. It almost doesn't matter for certain entities outside the United States. So a lot of geopolitics that are very interesting there. You mentioned strategy. Can you talk about the fight over US dollar capital for Bitcoin strategies? Obviously, strategy is the clear leader by a few miles. I think no one would argue that. You have a group of companies that are charging up or trying to fight for that number two spot. But can there be hundreds of treasury companies? How is yours different? And how do you think about strategy specifically in your approach to raising capital and fighting for that next dollar?
Yeah, so first off, I'm just such a massive fan of what Michael Saylor and Strategy have done, and I would actually classify it that they're more than a few miles. I don't even know they're basically on the moon already. But what's interesting is actually taking some parallels to my background running a large fixed income portfolio, and so when I used to run a $70 billion fixed income portfolio, there were many advantages to managing a portfolio that size, and there were also disadvantages in trying to earn alpha. Because when you think about how do you earn alpha as the 500-pound gorilla, anything that you want to do to move the needle has to be massively scalable. And so when I was managing this bond portfolio, I would see opportunities all the time to make money in like $100 million chunk. But $100 million chunk or a $500 million chunk for a $70 billion bond portfolio is more of a hobby than something that you can actually do to create alpha. And so I think that there is a lot of opportunity for smaller companies to pick up alpha that would not be meaningful to strategy. I think that's just the true in any different industry, whether it's startups. Why do startups emerge that take things that maybe in the future Google acquires, or they actually rise up to be a competitor? Because at the time they're too small to rise to the level of significance for Google. But for a shareholder of the smaller company, what you care about is total return. And so the total return of a smaller company could compete or exceed that of strategy. And this is also similar to just like if you think about growth companies versus value companies, generally, I think of strategy as the value company in Bitcoin treasury space. And a value company in Bitcoin treasury space could have very high returns because it's tied to levered Bitcoin, right? So it's not a case that the future returns of strategy is not going to potentially be great. But I do think that there will be many opportunities for Bitcoin treasury companies that are smaller to do things that do well, but also they're going to be more risky. I wouldn't be surprised to see, a smaller Bitcoin treasury company or a couple or a handful blow up because they might take excess leverage. I mean, that is to me one of actually the beauties of capitalism is that in a capitalist society, it usually will regulate itself by companies making mistakes because they have the freedom to do so. And if you think about, what Strive has done today, we've taken zero debt actually right now. I think we're the only Bitcoin treasury company that's announced a reverse merger or a SPAC transaction that has zero convertible debt. And that might feel more consensus now that Michael Saylor's come out against convertible notes. I think even on his call yesterday, he talked about potentially retiring their existing ones as a KPI for them. We turned them down before that was where the market was going because the terms weren't good. And that's just like an honest truth, right? And I think that's important to lean into transparency. But like, well, what were some of the terms that we've got that we've seen other people take as well? Some of them were actually forcing the pledging of your Bitcoin, so encumbering your Bitcoin. And so oftentimes at a multiple of the actual Bitcoin that you held. So if you think about, downward scenarios, and I'm extremely bullish. And so in a probabilistic scenario, I don't place this as some high probability, but imagine a scenario where Bitcoin dropped 50, 60% over the next 6 months. You would likely see some current Bitcoin treasury companies explode. Strategy would not, Strive would not, because we have no debt, but other terms that have been taken are very risky. And so, probably a, whatever, 10%, 5% scenario, but a non-zero one. And so that's just part of the differentiation. And then, part of the other one is, we'll be able to do the perpetual preferreds. We'll be able to do alpha strategies. So if you actually look into the alpha strategies that we've announced, every one of them could be meaningful to Strive, meaning that for the size of our balance sheet, which will be large but small relative to strategy, these things are movers in the returns of our portfolio. None of them would be movers for strategy. So like they can't even, there would be no reason for them to compete with us. And so those are just some reasons why I think that, both bullish but also cautious on some of the newer Bitcoin treasury companies.
So why haven't you guys taken debt? And what are you telling your shareholders or those that you're raising equity capital from, the reasons that you're not taking debt? What you don't have to name a company, but what are you pointing to that, hey, that's the behavior that we're trying to avoid? We think that these are the companies that will go under if they employ these strategies, so we're not doing those types of strategies. Get a little bit into the details on what is separating you, and what are the risks to you guys not issuing debt that you're telling your equity holders.
Yeah. So we are planning to do fixed income and debt instruments. It's just on certain terms. So we turned down convertible notes, and I think at this point that is now a consensus opinion. But basically, every new entrant to the market has convertible notes, and so ours was specifically around that. We did not view it in the best interest of our shareholders to have to pledge our Bitcoin and be at the exposure of margin calls in downward scenarios to repledge and then potentially have to sell Bitcoin in certain unlikely but possible scenarios. And because a 50% decline in Bitcoin is not some like tail risk 0.1% probability. Bitcoin is a volatile asset, so we turn those down. But we are a big fan of the perpetual preferred offerings, and so this gets into we will have the ability to, because we did a reverse merger, we will have the ability to shortly after our SPAC transaction closes to do things like that if we find it to be to like the terms, to be in the best interest of our shareholders. Where someone that, as an example, did a SPAC, they could do a perpetual offering, but only to like a 144A offering to accredited investors. They couldn't actually do the IPOs like Strategy has done to actually then leverage the ATM on those types of instruments. And so we likely have that full option suite available to us, and look for really what it is it's longer duration debt. And so if you actually even look at Strategy's newest offering, which is for investors a 1-month reset of the interest rate, the actual maculated duration is over 10 years because it has no official maturity to it. Even though the effective duration for investors is very low. So I look at this as what are Bitcoin treasury companies? They are permanent capital vehicles making a long-term play, not a short-term play. Even though the stock's volatile, this is a long-term play in the rise of Bitcoin relative to fiat currencies like the dollar over time. And so you would prefer your debt to have a long duration and not be callable in the short term, because then you can't ride out short-term fluctuations. And so I think these perpetual preferreds are really interesting offerings. And so, there's a potential that Strive could have, similar things to what you see from Strategy. And then on top of that, our alpha strategies that I believe will be meaningful to our shareholders because of the size of our treasury. And that kind of becomes the in a sense, best of both worlds. Like if we had those perpetual preferreds going, we would be the only Bitcoin treasury player in the market that only has common equity and perpetual preferreds as our two offerings. And even Strategy itself is trying to get rid of their convertible notes. And I think that's kind of a shows you kind of that they don't view those as the direction for their company.
And we really appreciate you breaking down the differences between common preferreds, the convertibles that some companies are doing. There's no financial arrangement between the Bitcoin layer and Strive. This is an episode purely for research purposes. This is not an endorsement of Strive or any of its individual investment products either. Matt is just being kind and sharing his time, giving us some perspective on what it's like running a Bitcoin treasury company, running an asset manager, a very unique company. So we do appreciate your perspective, Matt. Thank you for joining us today at the Bitcoin Layer. And please tell people where they can find you online.
Thanks, Nick. So easiest way to find us online is on Twitter. So my handle is at ColeMacro, ColeMacro, and then at Strive Funds for our company. And then our company's website's at strive.com. So thanks, Nick. Appreciate this.
Of course, Matt, thanks a lot. And we'll catch you guys next time.